In this episode, I sit down with Joseph Hogue, founder of the popular YouTube channel Let's Talk Money. We discuss how Joseph got started with dividend investing and why being an owner is important to achieving financial freedom. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Joseph is a veteran of the Marine Corps and holds the Chartered Financial Analyst designation, CFA, and has appeared on CNBC, Bloomberg, and Fox Business. In this wide-ranging interview, we cover dividend investing, dividend growth, and how to get started. Joseph, welcome to the Simply Investing Dividend Podcast.
Well, great to be here. Good seeing you again after FinCon last year.
Yeah, great to have you on the show today. We're going to talk about dividends, dividend stocks. So why don't we start with tell our audience a little bit about yourself and how you got started with dividend investing.
Sure. Well, I've been investing since 1999, right, which was a great year to start investing. I think a lot of investors over the last couple of years can relate to that, or I can relate to them, just starting investing and then, the whole bottom falls out of the stock market. But started investing while I was in the Marine Corps in 1999. Actually got really interested in equity analysis and learning that part of the industry. So I've actually worked for a little over a decade in the industry as an equity analyst. Worked in venture capital as a sell side analyst, as well as private wealth management. Over the last 5 years, I've been posting videos on YouTube on my YouTube channel, Let's Talk Money, exclusively in investing, equity analysis, which stocks to buy, and really primed for dividend investing.
Oh, that's great. That's great. So you've been doing it for a while. You've been investing in for a little while now.
I have. I got the CFA designation back in 2011. I've been working as an equity analyst and freelance analyst since then.
Okay. So why do you prefer dividend investing versus other types of investing that's out there?
Sure. Well, it's even more important now, dividend investing, that you're getting those constant dividends and those regular dividends, right? It's right now, it seems like it's the only source of positive returns with stocks going down. So, not only do you always have that positive return from the cash flow, then it's a great motivator as well. I see so many investors just lose faith in stocks, or they get discouraged when they see their portfolio falling in a stock market crash. But those dividends hitting your account, it is a great motivator to be able to say, hey, I'm doing something right here, getting those dividends. So I need to keep on investing, growing that portfolio. And it can really, it really does a lot of good things as far as keeping people investing every month after month, even if stocks are going down.
Yeah, absolutely. And I totally agree. I've been doing this for a little over 20 years, and the dividends coming in, amazing. It is a great source of passive income. And to see the dividends growing year after year is fantastic. Okay, so I'm going to bring up a quote. I'm going to mention your book because I think your book is fantastic. Everyone should take a look at it. The book is called Step-by-Step Dividend Investing, and we'll put a link in the show notes. I believe it is available on Amazon. That's where I got it from. Okay, so you've got a quote in the book, and I'm going to read this out for our audience as well, and then I'm going to ask you a question. So in the book, the quote says, while investing in other stocks may offer the dream of getting rich when the investment is sold, regular dividends put cash in your pocket that you can spend or reinvest. So the question is, do you recommend for young people to reinvest those dividends, and why?
Oh, absolutely. Sure. Really for anyone not relying on that income, reinvesting the dividends is the only way to really grow the portfolio and put your money to work for you. That's really what we're talking about with investing, is getting your money to work for you. And if you're constantly withdrawing it, then you're losing that power. So that power of compounding returns, right? What Einstein called the eighth wonder of the world, then is really in that dividend reinvesting. So young investors, old investors, every investor.
Yeah, absolutely. And what I find is, in my experience, it creates a snowball effect. When you're first starting off, it's not a lot. The dividends are like 25 cents a share, 80 cents a share. It's not too much. But once you start investing in those stocks, you get the tiny little bit of dividend, reinvest it into other stocks that are going to pay you dividends. And now that tiny amount just gets bigger and bigger, and it grows.
Sure,
over
and
years.
I think that's why a lot of new investors or younger investors are kind of a little bit discouraged when they talk about or when they first see dividend investing because they've just started out, their portfolio might be fairly small, so they're not really collecting a whole lot for dividends. But if you do start while you're early, reinvest regularly those dividends, then in 10 years, 20 years, then you will look back and be glad that you did. You'll have that portfolio of four or 500,000 where you're getting that 20, 30, $40,000 a year in dividends, right? And that just doesn't always happen with growth stocks, right? Growth stocks, they can provide some great portfolio return, but if they don't, then if your growth stock just kind of goes nowhere, then there's no return, whether it's over a year, 2 years, or 20 years.
Absolutely, I think it's just kind of human nature to go after the bigger numbers when you see something like a Tesla or a Facebook just doubling or tripling in less than a year, and you just want to jump in, right? And I could make a 300% return in such a short period of time. Sure. But that, like you mentioned, it doesn't always work, and you have to have the timing right. And unless even if you've got a Bloomberg terminal, you may not get the timing right exactly how to get in and out.
Sure. I guess come to think of it, dividends are probably the tortoise of the tortoise and the hare race, right? The tortoise is going to eventually win out if given enough time, unless the hare, gets off his butt and actually starts running. So there are good growth stock investors, and don't get me wrong, growth stocks can do very well for you. But unless you have that discipline and can find those stocks, then dividend investments are going to win out every time.
Yep, that's a great analogy. I love that. Okay, one more quote, because I really love this. You got a lot of good quotes in the book, but I'm going to pick one more here. And I think it's great for our audience to understand this as well. So the quote in the book says, and this is your book, it says, dividend investing may just be one of the only true paths to financial freedom. The safety and reliability of dividends turns you into an owner, collecting income off the assets rather than simply a tenant of other people's assets. So here's a question. For someone striving for financial freedom, why is it important to be an owner?
Sure. Well, of course, on its even growth stocks. Okay, you're an owner in the stock, and you're owner of the company, and that's the only way to. How many? I can't think of any a good analogy to find a rich person, right, or somebody that has that family legacy wealth that wasn't built off owning assets. Okay, if you don't own assets, you're working for your money. Right? There's only two ways to make money, right? You either work for it, or you earn an income off of those assets. It works for you. Your money works for you, right? So obviously, that's a given. You have to own assets. You have to invest and buy those assets. Where I think it's intrinsic in the value of dividend stocks, and maybe a little bit even more than growth stocks, is just because management has that kind of cash discipline. They know investors are relying on those dividends, so maybe they can't go after all those vanity growth projects that a growth stock or a growth company could. They have to fulfill that dividend promise to investors. Investors have that steady and reliable income stream from the dividends, and just by virtue of the trade-off between reinvesting in the company's growth or paying out the dividends. I think most dividend stocks, they tend to be companies or sectors where it's a little bit more mature industry. There are limited growth opportunities, and so it tends to be value stocks, more safer stocks in utilities, consumer staples, things like that, real estate and energy. So they just naturally tend to be those safer, more mature companies as well.
Yep, absolutely. I completely agree with all of that. And it's so important when you're an owner versus, like you said, working for money. Because when you're working for money, there's only so many hours in a day that you can work. And there's only so much money you can make, right? If you're a lawyer, there's only so many clients you can see. If you're a painter, there's only so many houses you can paint in a day. So there is a limit there. Whereas with dividend investing, you can start to compound, like we talked about before, reinvesting the dividends, and that's where your dividend income grows. And we're going to talk about that a little later, is the companies themselves increase the dividends. And so that's more income into your pocket, right? Okay, so here's a question, Joseph. What do you look for when you're evaluating which dividend stocks to invest in?
Sure. Well, first, I'm looking for what I look for in any company, right? Some kind of a competitive advantage in its industry, okay? Because I don't care what industry you're in, even if it's a regulated market like utilities, there are still competitive forces that you want to be in the stocks that are dominating their industry, right? That's the only way that they're going to be able to grow earnings, and earnings growth is the only way you're either going to get a higher stock price or a higher dividend, or both, right? So I'll look for sales growth that is higher than competitors, right? I'll look for operating margins that is higher than competitors, and those are just kind of two quantitative ways to get into that qualitative idea of an advantage, right? If you find that between the soft drink makers like Coke and Pepsi and Dr. Pepper, if you find that the industry as a whole is growing sales at maybe about 2% a year, but one company you find is growing at 3 or 4% a year, then why is that? Why are they able to grow those sales, those revenues so much faster? And is it a sign that company is taking market share away from the others, right? If you find one of those companies has an operating margin, which is one of my favorite metrics, right? Really that core profitability metric of a company. Then if one company has a significantly higher operating margin, why is it able to do that? Does it have pricing pressure or pricing power over competitors, over customers? Does it have just better management? Something like that. So really kind of easier ways, because I know you talk about competitive advantages, and it's real hard to say, okay, what is a competitive advantage? What is an innovative product that is going to do that? So these are just quantitative ways that you can look for a company that might have a competitive advantage in its industry, because those advantages are then in turn going to lead to higher earnings growth, higher sales growth, and things like that. So that's one thing I look for just in any company, right, or in any investment strategy. Beyond that, if I'm looking for dividend stocks in particular, then some of the easiest things to do are just look at the dividend history. You can go to Yahoo Finance, go to the historical tab, and it'll show you the dividend history of that company. And you make sure that they're not cutting the dividend regularly. You can make sure that they're regularly increasing their dividend payments. Calculated dividend growth, that kind of thing. So by that, you just get an idea, a sense of commitment to investor cash return from that company, whether it's a stable commitment there or increasing preferably. So you're looking for things like that. You're looking for, just higher stock price too. I know a lot of investors, dividend investors, are going to prioritize those high yield stocks over any kind of a share price return, but there's a balance there, right? I know one of the most popular dividend ETFs, that QYLD, right, has just absolutely destroyed investors on a capital returns basis, right? The stock is down, or the ETF is down something like 30% over the last couple of years. Even though, it does provide that about 10% dividend yield, and investors are fine with that. Well, what happens if you ever do need to sell that stock, and you're going to lose quite a bit on that exchange? Okay.
Yeah, that's all great information, right? Are there other things? I was going to get to the payout ratio, so I don't know if you're headed in that direction. But is there anything else that you're looking for before you decide to invest in a particular dividend stock?
Sure. Well, I would include the payout ratio. Definitely. Absolutely. You have to compare the payout ratio. A lot of these go into really kind of a list of the top 5 mistakes that investors make, right? One, and we can go deeper into these, but one, I'm not chasing yields. I don't want a dividend stock or an ETF over maybe 10% yield, because it's generally not sustainable, or if it is, not on a long-term basis, right? So if there's a stock paying more than a 10% yield, or even an 8 or 9% yield, I'm wondering why. Is it just because the stock price has gone down so much? Is that sustainable over the long term? And can the stock price come back up to lower that yield? Using the wrong coverage ratios. I see a lot of people doing that, whether, so you're talking about the payout ratio in most dividend stocks, right? But I see too many investors use the payout ratio for real estate investment trusts or for MLTs, which of course you should be using some kind of another coverage ratio, like FFO coverage or distribution coverage, right? But just because those business models are so different than your normal company, right? With the depreciation expense, only investing in high yields or monthlies. Whenever I look at my dividend portfolio, I love those monthly payers, right? And I love the high yield payers, but I want to spread out my dividend portfolio outside of those too, right? Because a lot of times those high yield stocks and the monthly stocks are just in exclusively in, MLPs, REITs, mortgage REITs, or BDCs, right? And so that's going to leave you very much exposed to just one part of the market, if you're only chasing those. Not caring about that capital destruction, right? So I want to see that even if the stock price hasn't boomed higher, has stayed relatively flat, I don't want to see a whole lot of capital destruction in my dividend stocks because eventually I will sell them, and I want to be able to book some kind of a return off that as well as my dividends. Like I said, a lot of investors in the QYLD, they're getting frustrated and disillusioned now when they're looking to sell some of those shares, and they're finding out that they've lost so much money on the share price of that fund that it's basically wiped out a lot of the dividends that they've collected. So it's something you really need to pay attention to.
Yeah, those are all good points, and it is something that I've always talked about, being educated before you go and even spend $1 investing your money, whether it's individual stocks, index funds, ETFs, or mutual funds. You got to have the knowledge before you jump into any of this, because this is your hard-earned money. And at the end of the day, nobody cares about your money than you do.
Yeah,
right?
yeah.
Yeah. So I want to mention to my audience, you do have a YouTube channel. Again, we're going to have a link down below in the description. It's called Let's Talk Money. I really enjoyed your most recent video from a couple of days ago, and it's called, I want to recommend everybody to go check this out. It's called the 5 Safest Dividend Stocks for the Perfect Dividend Portfolio. So awesome. Great job on that. In that video, you do talk about the payout ratio. And just for our audience, for especially the ones that are new, can you let them know what is the payout ratio and what's wrong when it's too high?
Sure. Well, the payout ratio is just the percentage of profits paid out as a dividend, right, to cover that dividend. So what you're looking at here, and again, this is not for real estate investment trusts. This is not for master limited partnerships, MLPs, or BDCs. They have, those types of businesses have so much depreciation on the income statement that earnings are not a good measure of actual cash flow, right? For most companies, earnings are a good substitute for cash flow. So you can use the payout ratio, which is just the dividend amount per year. So the amount of the company is paying out in the dividend per share per year, divided by its earnings for that year. Okay. And again, this is just how much of the earnings, the profits of the company is taking out and to pay dividend investors. And it's very important because think about it this way. How much are they holding back? The opposite of that is how much they're holding back for growth in the company. And a lot of dividend investors might say, I really don't care what they're holding back for growth. I just want my dividends and I want a higher yield. Well, the problem with that is a company that's not holding anything back for growth, might not be staying competitive with its peers, and so it's going to lose sales, it's going to lose market share, and eventually it's going to have to cut that dividend. So it's a very important concept for dividend investors to make sure that, that payout ratio is low enough that they have enough money to invest for growth and the future stock price, right? And what you want to do, I see a lot of investors just, if they do use the payout ratio, they'll look for the lowest payout ratio possible and not consider analyzing that payout ratio against an industry, right? Against peers. And it's the same thing when you do any kind of analysis. You really need to analyze the company against its own direct peers, its own industry to see, how it stacks up against that, because some industries, some sectors, like maybe, so if we talk about utilities, consumer staples, then they're obviously going to be able to pay out a lot of their earnings as a dividend. They've got fewer growth prospects, right? It's more mature industries, regulated industries, things like that. And it's very, very dependable cash flow. So they don't have to really worry from one year to the next how much cash flow they're going to have to be able to reinvest in growth. They already know that. So they can offer payout ratios as high as maybe 60 and 65 and 70% right now. I think right now Coca-Cola is right around 75%. Pepsi is about 65, 68%. Whereas tech companies, maybe some of the other companies that have more growth opportunities and that need to reinvest that into that growth, they might have a payout ratio closer to 40%, 50%. So in that case, if you find a company that's got a payout ratio of 60% or 55%, that might be dangerous. While something in the utilities sector that might be very low, actually. So what you're doing when you're analyzing payout ratios is, one, you want to make sure that compared to its peers, it is low. Okay, so it is possibly reinvesting more money, or it has more room to grow the dividend, right? A company with a payout ratio of 50% versus the peers in its industry with the payout ratios of 60, 65%. Well, that company is either going to be growing faster, hopefully, if it's reinvesting more money, or it's got all that room to grow the dividend, which is obviously very important for dividend investors as well.
Yeah, absolutely. And now the problem, like I will stay away from companies where the payout ratio is over 100%. So,
well, sure.
As an example, if the company is paying a dividend of $2 a share, and the earnings was only $1, so now the payout ratio is over 100%. Where are they coming up with the money to pay the dividends?
Absolutely. And sometimes what you want to do is do normalized earnings, right? So if a company is just having a bad year, if they're taking a lot of write-offs, what we've seen this year is a lot of companies are using the economic downturn to take a lot of write-offs or impairment charges, right? They'll write off, $500 million worth of their goodwill, take that against their earnings, and they've got, hugely negative earnings for this year. Well, that's not really a normalized earnings, right? So you either want to back out of those to find more appropriate adjusted earnings for that year, or take like a 3-year average of their earnings and use that in the payout ratio, right? Because even bad things happen even in good companies. So you can't take just 1 year of lower earnings and say, this dividend isn't sustainable, because they could keep on if they're going to bounce back next year, be able to cover it. What a lot of companies will do in that instance or in that circumstance is maybe they'll just take on a little bit more debt during the year to fund that dividend that year until they rebound the next year. One other thing that I covered in that safest dividend stocks video was, the companies that have a history of paying down their debt, over the last few years, and right, are buying back shares. Those are both sources of cash that they can use to pay to keep the dividend growing, even in hard times, right? Because stock buyback programs can be discontinued or slowed down. Debt payment can be slowed down just above what they need to pay with maturities. So any company that you see is, even if it does have a high payout ratio, even if it does look like earnings are going to be lower this year, if they're paying back debt quickly, or if they've got a stock buyback program, then the dividend might be a little bit safer than you might expect, because they can slow down these other two uses of cash and put it into the dividend for this year.
Those are all good points, especially what you just mentioned there before is a company may have just a bad year, right? Mm-hmm. Just 1 year so the payout ratio is now like 100% or 99%. Sure. And some investors may panic, and they see that and they're like, you know what? I got to get rid of this stock. I just got to sell it. And what you're suggesting, I think, is important, let's take a look at the last 3 years or the last 5 years. Let's average it out. And, are the earnings sort of going up, or are they doing this? If they're doing this, then you have to investigate more. But if they're going up and you've got one bad year, probably okay. So that leads me to my other question then. What are some of the things that you have to see that would make you sell a stock that you own, even if it's paying a dividend?
Sure. Well, it would, obviously, some of the easiest things to look for would be, a creeping higher payout ratio, right? Which would be, maybe a dividend that's growing, but the earnings aren't going anywhere, or the earnings are actually falling on a successive year-over-year basis. It would be, a slowdown in earnings, or a slowdown sales or earnings growth. A lot of what we looked at when we decided to buy the stock, right? Are the sales growing faster than competitors? Are the earnings growing faster? Is the operating margin higher than competitors? If those start to normalize to the industry, right, then it's a sign that maybe the company is losing that competitive advantage, or that, the other companies are just picking up on it. So it's not so much unique to that one company anymore. It can be a great warning sign for a company that, has been able to grow its dividend by whatever, single digit, double digit percentages a year in the past, because it had this advantage and it was growing its earnings, growing its sales so much faster. But now that it's normalizing to the rest of the industry, it is not going to be able to keep up that kind of dividend growth, and eventually may even lose market share and have to cut the dividend. So, So definitely, in my yearly analysis or so of my portfolio, then if a stock does look like, or if a company does look like it's losing those advantages, then I'd have to reevaluate, whether I want it as a long term, or at least watch it to make sure it doesn't get any worse.
Yeah, and I know some investors, dividend investors, as soon as they see a dividend reduction, or they'll just sell the stock. Do you do that, or you investigate further and then make a decision?
Oh no, of course not. I mean, first of all, that dividend cut is generally, once it's announced, then it's fully reflected in the stock price, right? So, and you get a lot of knee jerk sells on that news. That a lot of times, then it is now a good deal, right? They have cut that dividend to protect cash flow, so the remaining dividend is secure. It's safe. They have more cash flow to reinvest in the company and grow the company, and they're generally going to be looking at cost cutting measures as well. So, you've probably got higher operation or higher profitability in the future, and eventually, back to that dividend growth. So that's the worst time to sell a stock, right after the news, because that's going to be reflected in there. Generally, the market sees a dividend cut coming, right? So you'll see a dividend stock falling pretty quickly, and you really want to stay on top of it and look into those to see, okay, what is the market looking at? Why do they think maybe a dividend cut is coming, and that's the reason for the sell off.
Yeah, and one of the surprises for me, and I'm sure for other investors too, was in March of 2020 when COVID hit. And we saw immediately with Disney, who had been paying a dividend, who had a good track record of paying a dividend, just cut it to zero. Mm-hmm. And what would you do in that situation? Assuming, let's say you had Disney, and then what would you do? Would you sell it, or would you hang on to it?
Sure. Well, at that point, you really can't. I can't do anything, just off the news, right? March of 2020, we didn't know how bad that was going to be. It could have been a depression, really. We didn't yet know that the Fed was going to come out with a $5 trillion bazooka to stabilize the markets and drive shares higher. So, management was just taking the decision to protect cash flow, as at the time, and that they did that through cutting the dividend. A lot of companies cut the dividend at that point. So you really couldn't. You couldn't say, I'm going to sell Disney and buy something else, because there was nothing else to buy at that moment.
Yeah, and I've heard, and I don't know how true it is, there's stuff on Twitter, there's stuff on Reddit, where people are suggesting that Disney may reinstate the dividend, but I don't know. I haven't heard anything yet officially from the company, but that would be good news for dividend investors.
Sure. And without a doubt, they will, eventually, right? Every company eventually has to reinstate their or start a dividend, because that's the only way, other than an acquisition or an acquisition or a merger with another company. That's the only way investors get any kind of a return, right? Unless they're selling the stock. Now, obviously, a company can't tell people to sell its stock and collect that return. So they have to give them some kind of a cash return through dividends. So, Tesla will eventually pay a dividend. Amazon will eventually pay a dividend. It's just a matter of when those growth prospects are low enough. I think with Disney, you have to look at, they're spending so much money right now in streaming that they need that cash flow to reinvest in that content rather than pay it out as a dividend. So as streaming becomes a little bit less competitive, I'd say maybe over the next year or so, then I would fully expect Disney to return some of that money instead of using it all for the growth. Yep.
I think a lot of people forget that at one point, Microsoft and Apple didn't pay a dividend, right? And today they do.
Apple, it wasn't so long ago, really.
That's right. Yeah. So it's just a matter of time. And I think it, like you said, as the company matures as well, and it's getting bigger and bigger, they get to a point where they're like, hey, we need to return something to the investors, like you said, to get them to sort of buy into the stock. Now, we talked earlier very briefly about dividend growth, the company increasing its dividend every year. And you had a really good point in one of your recent videos, probably the same one I'm looking at here, the 5 safest dividend stocks. Can you tell our audience what is a dividend aristocrat and what is a dividend king? Stay tuned next week for Joseph's answer to my question. In part 2, we continue our discussion and Joseph talks about how he's investing in today's economic climate and where he thinks the market is headed in the next 12 to 24 months. So stay tuned next week for part 2 of my wide-ranging interview with Joseph.